Now, Chris Conway from Australian Stock Report joining us live from our Melbourne studio. Chris, welcome to the show on a busy day for the market. Let's kick it off with the big story of the day, NAB. What do you make of this number, the result today? Of course, it's all about that $5.5 billion rights issue. How do you think investors will respond to this one?
Look, the numbers themselves were actually reasonably solid. There was a bit of a decrease in net interest margins, which is a little bit concerning, but as you say, Ingrid, it's all about the $5.5 billion capital raising and what that will mean for the bank moving forward. Part of that, of course, is to cover off the £1.7 billion the UK regulator wants them to have so that they can divest their assets in the UK. Of course, the other monies will be to shore up their balance sheet amid some ructions recently about capital adequacy ratios for the banks. Of course, we saw Glenn Stevens talk about that recently, and the Financial System Inquiry also wants the banks to be particularly strong to foreign investors. Of course, they make up the funding gap between domestic deposits and lending. So, yeah, the numbers themselves reasonable, but a massive discount at $28.50, I think it was, that they're raising the $5.5 billion at, and we would expect to see NAB fall fairly sharply when they come back online. Will
it give some sort of reprieve, I guess, to investors that they now know what's going to happen to these UK banking assets?
Yeah, absolutely. The UK assets have been a big worry for an extended period of time now. Of course, it all depends on the price they get for these assets, but you know, they probably will have a big war chest. Again, I would assume that money would be used to shore up their balance sheet and again defer some of those capital adequacy issues. But yeah, absolutely, divesting those assets will be a good thing, and longer term, sort of 12 to 18 months out, it should be a good thing for NAB, most definitely.
Yeah, well, let's put it in perspective, because the other banks have obviously announced capital requirements, sort of upping their capital, I guess, to make up for these requirements that could be put in after that stability review. In terms of where NAB will stand versus the others, how do you think it will stand when you compare it?
Well, I think obviously their move is probably the most aggressive. I think it was ANZ and Westpac did some moves through their DRP that you know, will raise capital and shore up their balance sheet, but not as aggressive as the move from NAB. So coming out of it, yeah, again, you think it would be a positive thing for them. It will put them in a very strong position, and probably behind CBA as the most preferred banks.
Okay, so what about the bad debt cycle that we seem to be seeing sort of the trough for that, and it looks like it's only going to increase from here? Are you interested at all in the banks now going forward, or is it the end of the sort of yield trade when you look at the banks?
Look, I do think it's the end of the yield trade, but it depends on whether you're a trader or an investor. In terms of trading, you know, the RBA cutting rates again the other day absolutely had no impact. That, of course, has been offset by some soft results. I think in the near term, the risk is to the downside for the banks as traders get hold and short, or you know, longer term investors sell out. But longer term, you know, what have we seen? We've seen CBA off 14% from the highs, plus what it's down today. The rest of the banks down around 10%. Yeah, they start to become more compelling, certainly more compelling than they were. But it's that two-stage process in terms of whether you're a trader and you want to be selling the downside, or whether you're an investor. I think there's probably a little bit more in the banks. Like I said, maybe another 5 or 10% and they become really attractive. But you know, we just need to wait and see how it plays out.
A lot of investors are sort of wondering what to do now in the market, given that, you know, we are seeing red sort of across the board, and markets yesterday losing that 2.3% and then further losses today. Is there anything that you're liking at the moment that you're buying into in the market on these dips?
Yeah, absolutely. So it's off the back of the inflation story in the US. Inflation is starting to pick up, and most significantly, we're starting to see some wage price growth, and of course that will feed into inflation and help the inflation level get back to the Fed's target of 2%. What we expect there is that when the inflation does come, it's going to come very, very quickly. So not a lot of lead time on this one potentially. And of course, the stocks that stand to benefit, or the commodity that stands to benefit, is gold. Traditionally seen as an inflation hedge, also a defensive play as markets tumble and there's a bit of fear and panic out there, which we're starting to see obviously locally. So yeah, the gold plays on the back of that theme. Saracen we particularly like. MML is another one. Medusa Mining. They have some quality assets. They have little debt. And they're trading at a discount both to the market and some of their bigger peers such as Newcrest. So we think that's a theme that's starting to pick up. and early movers we think will be rewarded if they start to have a good look at some gold plays.
Chris, in terms of the market, where do you see it going forward? I mean, is this a correction? Are we going to see more downside from here in your view?
Yeah, I honestly think we do. It's a little bit dependent on the 56.60 level. That's a major support level, and as you said in the lead up, Ingrid, the market has bounced from today's early session lows and moved back towards that level. So yeah, if that holds, we could see a bit of a rotation higher, but medium term, I still think the market's moving lower. You know, we've seen again the RBA cut rates; it hasn't done anything. The banks are getting crushed, and they make up 40% of the 47% of the market. So potentially we move down to the next support, which is at 5,400, and that of course would be 600 points off the highs and about 10%, so correction territory. So I think there's still some more downside to come.
And they come out with a pretty strong easing bias. Do you think people will get back into the market?
Sorry, Ingrid, I just lost you there. I just lost the audio.
Just saying, if we see, you've said you're worried about the RBA, the fact that the RBA cutting had no impact, but if we see the RBA out tomorrow and they put a strong easing bias in that statement of monetary policy, which is due tomorrow, what sort of impact do you think that could have on equities?
Yeah, well, again, I mean, it might reinvigorate that yield chase. Again, I'm a little bit more sceptical than maybe some other pundits out there. Simply because the last cut had no impact. Now again, as I said before, that was offset a little bit by the fact that that the banks have reported pretty soft results, but I think people are starting to understand that the RBA cutting rates, whilst it does fuel the yield play, it's also a significant sign that the economy is not performing and companies can't prosper in an economy that's not performing. So I think that story is starting to take off a little bit more, hence why, like I said, I'm still worried about the market at the moment and think there's further downside.
All right, Chris, we'll leave it there, but thanks so much.
Thanks, Ingrid.
Chris Conway there from the Australian Stock Report.